On InvestTalk today, I discuss the best 6-month stretch in markets we are about to enter. Then I look at the bullish market moves ahead of tonight's election. I also answer questions about Palo Alto Networks, Micron, Cameco, and more. And at the end, I look at rental rate trends across the country.
This is InvestTalk, independent thinking, shared success.
Now, my focus point today concerns the Wall Street hot streak. We've had a good year so far, but we are entering a cyclically strong period, actually the cyclically strongest period for markets. And this is as we have just come off good returns. And I still talk to investors that are weary that, markets are near all-time highs and it's not a good time to invest. But history suggests that November through April is the best 6-month window of the year in terms of the stock market performance. The highest average return in that period when compared to any other rolling 6-month stretch dating back to 1945. Okay, so we're talking about any 6-month period during a year or spanning over 2 different years. This is that period. Delivered average annual returns at nearly 7% per year from November through April, and the rest of the year only averaging 2% returns in the other 6 months. So this is the heart of returns generally. Now, so far, the S&P has advanced more than 16% since April 30th, obviously far outpacing that average of 2%. But what does that tell you about this next period? Was that take away from the gains going forward? Well, since 1945, there have been 12 periods of time that the S&P 500 gained 10% or more in that May to October period. And stocks advanced on average 13% in this subsequent November to April period. So it's saying that, that period can be strong, but in fact, the November to April period is likely to be a bit stronger on average. Okay, and this also is typically a good time for other sectors or other indices like the Russell 2000, as well as emerging markets. And just because stocks are up year to date, low 20% range, remember, there's a lot of years that have done much better. Last year, up 24%. 2021 are up 27%. 2019, 29%. In 2013, 30%. Over the first 10 months. So this is not atypical. It's not out of the ordinary. So the odds are good that the market will continue to climb the proverbial wall of worry. And the main reason here is seasonality, sure, but actually liquidity. Liquidity remains relatively robust. You certainly, if you look at central banks around the world outside of the Bank of Japan, you have pretty much every other central bank easing policy, especially the largest ones, the Fed, the Bank of China, as well as the ECB. Those are the 3 most important, and they're all easing policy. And then you have the credit cycle. The credit cycle continues to inflect positively, showing that we're closer to the beginning of a credit cycle, a positive credit cycle, as opposed to the end of the credit cycle, which would create a bankruptcy cycle. Now, could things change after this November to April period? I think sure. A lot will depend on government spending. Right? We have a debt ceiling fight probably at the beginning of next year. And ultimately there will probably be some concessions, and it will be, how big will those concessions be? What will the tax situation look like? What will if there's a new Treasury Secretary, what will that look like when it comes to issuing debt? We know that we're creating a lot of debt out there. So all of these are factors that will impact probably later next year. But if you line up what's happening in the short to medium term, this next 6 months, you get a better than average chance that we will continue to see more gains. Now let's take a quick look at the market performance for the day. Let me just pull up the indices real quick. There we Go. Okay. So the NYSE, that was up 1.15%, broad index there. S&P was up 1.25%, almost. NASDAQ was up 1.43%. So some pretty big moves there. Volatility actually ebbed throughout the day. Obviously, that is a positive sign for asset prices in general. And so it was a nice bounce back day after a little bit of a sell-off in markets over the past few days, past the, 3-4 days. And so, we're kind of back to where we were, on the S&P, back to where we were on the 23rd of last month. And so there just hasn't been a whole lot of movement, a lot of chop, which is kind of what you would expect, as markets are jockeying for position and trying to handicap one outcome or another. There's been heightened volatility in the options market, and that means a lot of people trying to play one side or the other, either protection to the downside or potentially the market taking off to the upside. Usually what happens, though, after one of these events passes is volatility gets compressed and you get kind of it going not up or down dramatically. And so that's likely what will happen going forward. Now, what were some of the big movers here? You did have, let's look at Tesla was up 3.5% today, Intel up 3.5%, Micron up 3.7%, NVIDIA was up about 2.8%. I'm just looking at some of the bigger names here. Amazon up nearly 2%. So that was the market today. Once again, there's a lot still on the play, a lot still to be figured out in the next 24 hours. And then you get the Fed meeting coming up later in the week as well. And so that will certainly have an impact overall. But certainly a nice day for markets as we head into this final election night.
Hi, Luke and Justin. This is Rob calling from Las Vegas. I had a question on ONEOK, symbol OKE. I picked up a position back in February in the low 40s, and it's had a pretty nice run up. And I just wanted to get your analysis on any future potential in this position. Be listening for your answer on the next podcast. Thank you.
All right, looking at OKE, and this is a name that we own for clients as well. We've owned it for a long time, and we like it because it's a consistent dividend payer. Right now, the yield's about 4%. I think we bought it when it was closer to 5.5%. So we've owned it for a while. I think we started buying it maybe in the 40s, 50s, something like that. And now it's at 98.61 at the close today. So, this is for everyone out there. They are engaged in natural gas and natural gas liquid gathering and processing in the Rocky Mountains. And so they've been a big beneficiary of the boom in oil production in the United States because they own a lot of the infrastructure, the pipeline to move it from the wells to where it can be utilized and sold. And so that's just a great business to be in when volumes are rising because they make a fee of every unit that they transport and gather and store and et cetera. And so, being in the mid-continent, Permian is an area that is growing in its number of wells and its output, and they've been a big beneficiary of that. So we don't see any reason to jump off the bandwagon as of yet. Obviously, it's not quite as cheap as it was when we first bought it, but it's still a very good company with very good economics, profitability, return on equity around 17%. They have a strong balance sheet and very strong cash flows. So I would continue to hold OKE. Thanks for the call. Now, hope you've been telling your friends that our audio podcast is available in video form over on our YouTube channel. You'll be able to see me and my face. You'll see some charts that we look at when we look at particular names, particular companies. You might even see my beautiful dog in the background hanging out as well. He's a yellow lab. And so if you want to head over there, you can check out some of those videos. And we get questions via the comment section. And Jim Leahy says, I would love your thoughts on NVT, which is Navient Electric. Let me pull this up here. NVT. All right, so this is nVent, I guess, Electric. They manufacture and market electrical connections and protection solutions in the United States and Canada. Earnings have been consistently moving higher throughout the pandemic. Made $1.50 in 2020, $1.78 in 2019. Now up to $2.80 expected this year and $3.24 next year. So you certainly like those trends. And if you look at the chart, however, it's starting to weaken. That's my biggest worry here. Is it had a nice run and it peaked out middle of the year, right around June, kind of when the big tech stocks started to peak out as well. When a lot of the just a lot of the semiconductor stocks peaked out as well. And it's now starting on a downtrend. I don't like the MACD. So I'm going to say that the technicals are a bit bearish. And that's the first red flag here. Now, the good thing is they have a good balance sheet, only about $3 billion in debt on an $11.5 billion market cap. That's fine. Good free cash flow at $581 million. So we like that, near an all-time high. That's certainly a positive. Return on equity, 18%. But once again, my issue is the expectations for earnings. If you look at the earnings expectations for this year and next year, they are supposed to be higher than they were last year, but analysts are downgrading those estimates. And that's probably why you're getting this break in the stock. So I don't like the earnings revision trends from analysts. I don't like the technicals. But overall, the business is solid. I like the business that it is in. I just want to see the technicals and the trends for earnings turn around. So until then, I'm going to pass on NVT. Thanks for the call. Let's grab a quick question from our voice bank now.
I was wondering if you could talk about the stock for Murphy USA. The ticker is MUSA. They own a chain of gas station and convenience stores. So I was wondering if you could give me your opinion. Thank you very much.
All right, looking at Murphy USA and about a $10 billion market cap. They market retail motor fuel and convenience merchandise in 1,733 retail stations in 27 states. Now, I don't know if you know this, but gas stations, convenience stores like this, they're very profitable, very good businesses. You have high margins because they can charge that. It's out of convenience. So they call it a convenience store. So if they're at a good location with good traffic, they can be extremely profitable. And Murphy, $430 million market cap on about $430 million in free cash flow on a $10 billion market cap. Decent free cash flow yield there around 4%. Now, what are they doing with that cash flow? They are buying back shares. So I really like that. Not a big dividend, but most of that cash is being returned to shareholders. And if I look at the chart, it is certainly in a nice uptrend. And I would give Murphy a thumbs up, MUSA. Thanks for the call. Let's go talk to Peter. He is in Rhode Island, and he's looking at HAYW, which is Hayward Holdings. Do you own it or looking to buy it?
So I was actually interested in buying it. This is my current employer, and they recently rolled out an employee stock purchase program where we can get a discount on the stock price. I was just wondering your take on it and if it would be a good short-term hold for a small part of my portfolio.
Well, the technicals look pretty strong. It's been an uptrend since November of last year when it bottomed right around $10 per share. Now we're up to $16 per share. It went public back in 2021, kind of around these prices. This is a very common example of an IPO. It pops initially for the first few months, and the lockup period happens, and then it sells off, and it did from $28 all the way down to $8 and change, and now it's climbed up to 16, kind of around where it went public. So it's been a bit roller coaster, but that's not atypical for new issues like this. And a small cap name, $3.5 billion market cap, solid balance sheet. You work there, so you probably know whether it's a good culture, a good leadership, etc. Based on the numbers, good free cash flow here, about $217 million. No dividend yield, but the trends are positive in earnings. Earnings supposed to go from 56 cents a share last year to 63 cents this year to 75 cents next year. Not a huge grower, but a quality business. So I have no issue you buying some of it at a discount from your employer, just make sure it doesn't rise to more than 10% of your total liquid assets, and I think you'll be okay.
Excellent. Thank you very much.
Thanks for the call. Good luck with it.
Hi, InvestTalk. I was hoping you guys could look at Cameco, ticker CCJ. I know you guys have talked about it before. I actually own it. I bought it in the mid-30s on pullback and gone up, done well for me, and now it's pulled back again. I'm looking to see if now might be a good time to add more as a small part of my portfolio. It also has earnings coming up on the 7th of November, and curious if you would maybe wait till after earnings, or if you just feel like now it's a good pullback and a good time to add some more to the position. And I'll listen on the show. Thanks as always. Take care.
All right, looking at Cameco, and this is a name that we've owned for a while, I think since the 20s, and now it's at 51.26 at the close today. It had a pullback in late summer from the mid 50s all the way down to the high 30s. But it bounced back pretty quick, and it made another new high here recently in October, right around $58 per share, and now it's pulled back around to 51. This is good support. Now, playing earnings or buying before earnings adds a certain level of risk, but also could mean if you wait too long and the earnings come in good, it might move away from you, and this could be that buying opportunity. So I might add maybe not your whole position. And that's something a lot of investors kind of miss, is that you don't have to buy the whole position at once. You can buy it slowly over time. And as pulls back and you get average prices at a bit lower, as long as the broad thesis, which for Cameco is that uranium is going to continue to be in higher demand as the AI craze, as well as the cloud computing trends continue, and higher demand for electricity, especially EV adoption, et cetera. And if you want clean energy, clean baseload power, the best way to get that is through nuclear power. And that will, I think, continue to be a trend for the foreseeable future, and why I think uranium prices will continue to go up. Now, it's going through a consolidation period, so not mooning at the current time. But I do think you will get another leg higher in the next couple of years. And Cameco, being the largest Western producer of uranium, that is a good vehicle for that. So I do think this is a pullback to buy, and probably before earnings, but obviously that does create a bit more of a risk. Thanks for the call. That was Cameco CCJ. Now, let's look at this election and what it might mean for markets. And the question for most people would be, the most important question should be, what outcome will tell you the most about markets? And so we'll look at the history of different presidents and what that might mean for the next administration. Now, this is a period of a lot of vitriol and especially hyperbole. I've seen this on both sides. If one side doesn't win, the world's going to come to an end. I can almost promise you that that's not going to be the case, no matter who wins. The reality is that presidents have historically had little impact, especially on financial markets. And often the short-term reaction to an election, too, is does not reflect the reality over the long term, especially if you're looking at asset classes, sector returns, etc. For example, since the Jimmy Carter presidency, the S&P 500 has had double-digit annualized total returns during every presidential term except for one. Think about that. And this is annualized, meaning you average the 4 years and it's over 10%. There's only one president that had negative, and that was George W. Bush. Obviously, he left office, during the financial crisis, so at a rough time. You could argue a lot of, some of that was due to his policies, but the S&P 500 returned the identical return during the Obama and Trump presidencies, 16.3% a year. Identical. Think about that. Two different parties, two different types of politicians with different goals, different policies, exact same returns. What does that tell you about the narrative around who's going to win and who's going to be good for the market, good for the economy? The reality is you don't really have a good sense because you don't know exactly how those policies are going to manifest. What are the unintended consequences? As well as, starting valuation matters a lot as well. So think of Bush starting in, taking office in January of 2001, excuse me. That was not a good time to start investing or start putting money in the markets. So investors often anticipate proposed policy changes and frameworks that will hit and change certain sector returns. But history suggests presidents have much less influence on different sectors than people think. And often it's the exact opposite of what is anticipated before the election. Trump in 2016 talked very negatively about the technology sector because they were, quote unquote, against him. And he pushed to expand the energy production. Well, technology turned out to be the best performing sector during his administration, and energy was the worst. And then look at the current administration pushing clean energy. Yet energy, the traditional energy producers, has been by far the top performing sector since Joe Biden took the White House. And then U.S. multinationals and emerging markets outperformed U.S. small caps during Trump's presidency, even though he talked a lot about protectionism. Right? You say one thing, but what do the policies actually create? It's not guaranteed that those words are going to match the actual outcomes. In fact, far often than not, they don't. Because guess what? They're politicians. And they say things on the campaign trail that very often don't come to fruition. So fundamentals such as earnings, valuation, they're more important. And political fear-mongering really doesn't help you make good investment decisions. Just look at the budget deficit. There's a lot of talk about it, but we know that both Democrats and Republicans are terrible on both sides of the aisle when it comes to spending. The U.S. debt to GDP grew the fastest. Guess under who? Ronald Reagan. And it passed the 100% under 100% of debt to GDP ratio under Obama and stayed that way under Trump and Biden. So these are trends that are very hard to predict. And so you really want to follow the charts and not the narrative. There'll be a lot of narratives that are created post this election. Don't buy into all of them because many of them will be completely wrong. Let's take a live call. Bill from California looking at Newmont Mining.
Oh, yeah. Hi, Justin. Good afternoon. Happy election day.
Thanks.
I called you about this stock a month ago, and, I've held it for on and off for a long time and have had a really good profit and still do on this. But you said you guys held it, and I'm just curious if you had lightened up on it on the way up or your general overlook. It looks to me like this recent setback is just, affecting the stock. But I think in the short term, I think it's probably going to continue an upward trend. But I'd like to hear your take on it.
Yeah, we agree. I mean, we think the market is overreacting to the higher production costs that were announced during the latest earnings announcement. But if you look at earnings trends, supposed to make $3.10 this year, $3.80 next year, both of those estimates continue to go up. And it's one of the largest mining companies out there. Good diversification across the world, from the U.S., Australia, Canada, Argentina, Dominican Republic, Mexico, Peru, etc. So a lot of different mines that are out there, and we continue to hold it. Good free cash flow, and we think that will still be a good performer long term.
So basically, this last news that came out is, like you say, it didn't seem that terrible to me, but it's just maybe some people who haven't held it as long just got paranoid and started selling it for that reason.
Well, I think that once again the worry is that their all-in input costs were higher than expected, and so that squeezes profit margins in the market. Didn't like that, but analysts continue to upgrade their earnings expectations though for this year and next year. So I actually think this is a pullback to be buying.
All right, thank you very much.
Thanks for the call, Bill. Now let's keep things going and play another caller question from 888-99-CHART.
Hi, this is Min calling from New Jersey. I have a question about Vertiv Holding. Ticker symbol is V as Victory, R is like Rob, T is like Tom, VRT. I was watching this stock since early September, and it's been up a lot since then. The recent earning is also very good. So let me know if I already missed the train or I should wait for a pullback. If I should wait, what's your recommended entry point? Thank you so much. Bye.
All right, looking at Vertiv Holdings. This is a company that is integrally involved in the building out of data centers, communication networks, commercial industrial facilities, and they have power, cooling, and IT infrastructure solutions. And so this is all about serving that big CapEx expenditure to build out AI and cloud services. And so earnings have gone from losing money in 2020, making 33 cents in 2019, all the way to making 264 this year and 345 next year. And if you want to play that trend, it's going to continue at this pace, then I would say you buy it. But I don't believe that this pace can be sustained and will be sustained for beyond the next, let's say, through 2025. I think you're going to start to see that these companies are overbuilding. A lot of these AI applications aren't going to be profitable. And so right now there's just a mad dash. And let's see this over and over. You see this in the semiconductor space where it's like, okay, I'm just going to build out as much capacity as I can to serve the needs of today. And then oftentimes they overbuild, and then they have to slow down and cut CapEx spending and kind of right size their inventory. And I think that's going to be the case over the next say 12 to 18 months. There's going to be probably a period where that comes to the reality for the industry. And so Vertiv will probably be hit because of it. Now, if I look at a weekly chart of this, I'm seeing some what I call MACD divergence on the chart, saying that this recent new high is actually a weak new high. So I'm seeing some loss of momentum on the technicals. You're also seeing this in the semiconductor space. You had obviously ASML and their backlog was struggling. And then what was another recent? I forget another recent semiconductor company. Oh, there was NXPI. That's what it was. I believe that was after hours, if I'm remembering correctly. And that was yesterday after hours. Yeah, this went down about $12 today, down from $236 to $224, down a few percent on the day. So they had bad earnings as well. So I just think it's you're riding a trend that could sustain itself, but as soon as it stops, the multiple that this is trading at is going to come back in dramatically, and I think you're going to see a big fall in Vertiv. So you could ride the short-term momentum, but I think there's a lot of risk as time goes on. So I'm passing on Vertiv. I just don't think the risk versus reward is there. Now let's tackle another question from our InvestTalk YouTube channel. And at Yoga says, can you offer your opinion on investing and buying Micron, MU? Thanks. Great. Thanks for the great show. This has pulled back from 155 all the way down to a lower on 86. Now we're at 105. I am liking the recent trend in the chart and earnings estimates. Let's take a look. They were going up. I know that. Let me pull that up. Yeah, they're continuing to go up to $9 per share this year and nearly $13 per share next year. So for everyone out there, they make flash memory and sensors for computers, servers, consumer electronic devices, etc. So the earnings are up and down. So understand that. But I do like the recent trend in the charts and future earnings estimates.
We hope you enjoyed this video.
Please consider liking and subscribing so you can stay updated with our latest content.
Hi, Duncan from New York, calling for stock ticker PANW, Palo Alto Networks. It is a tech. Just came in my stock screener, doing pretty well. Return on equity compared to a Fidelity.com, it is 63% return on equity and 14% on return on assets. PE ratio is about 49, so I know that's very high. Looking for an entry point. Thank you for all that you do. Bye.
Well, you kind of hit it on the head. It's a great company with great profitability, good balance sheet, but the problem is the valuation. It is, trading at 16 times price to sales. Its enterprise value to EBITDA is 91, very expensive on that metric. Free cash flow is about $3.1 billion, and based on enterprise value, that's about a 3% free cash flow yield. Now, that's not terrible, especially considering the growth. But the growth is starting to slow. It was growing in the mid-20s on revenue back in the beginning of 2023. Now we're at 12% last quarter. And going forward, analysts expect low to mid-teens. And earnings estimates are only supposed to grow single digits over the next few quarters. That's not that great. And when you're looking at a multiple of this size, and then if I look at the weekly chart, you're seeing some pretty good MACD divergence. Big drop back in February from a high around 378 and fell all the way down to 265. It's bounced back near the all-time high, but it's finding some resistance there. So I'm seeing some technical weakness on the chart, and I think this is ready for a multiple contraction. Probably next year. So a name to certainly keep on your watch list because it is a very, very good company, good profitability, good balance sheet, like I said, but I would pass on it for now because I think you're going to get next year a multiple contraction that will bring that price down significantly. Okay. Now, speaking of prices, let's talk about rents. And rents were too damn high during the pandemic, right? And they were growing dramatically. And in response, the free market produced a lot of new supply. In fact, more than 1.2 million new apartment units were built during the past 2 years. But interesting enough, those units are starting to fill up. The vacancy rate stopped rising for the first time in 3 years last quarter because the demand for apartments rose to its highest level since 2021. And so what you're seeing is that landlords are having more pricing power than they have in the last few years. And it's allowing building owners to raise rent. Now, some 672,000 new apartment units will have been completed by the end of this year, but only half that number is expected for next year and even fewer in 2026. And that means that rents for new leases nationwide have now held close to about flat for more than a year. And it is bifurcated, though. You're starting to see rents go up, back up in the more coastal cities, the Sunbelt cities, and some other parts. You're seeing big rent cuts, like Austin, Texas. That's probably the weakest part of the rental market, and a lot of the increased demand has to do with return to work. In places like New York City, Los Angeles, Indianapolis, Columbus, Ohio, they saw rent increases of 5% or more in July. Those are the places with the highest renewal rental growth. Even in Seattle, you're starting to see Amazon employees lock in apartments ahead of their return to 5-day office attendance in January. And this is a good thing if you're looking at apartment REITs. Okay, because they're the ones that are going to benefit most from a tightening supply of apartments around the country. Now, it will depend on what type of exposure they have to various markets. But it's something to take notice of, because this was a big worry, was that there was so much building of multifamily over the past couple of years that it could potentially bring these rents down. But you're starting to see a flattening out of those rents, and overall, there could be a place of opportunity. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics and calculate your investor risk number by heading over to investtalk.com and click on the portfolio review button. This is a free and confidential service. This is InvestTalk. Independent thinking, shared success. Good night.